A few months back, I think this was February, when one of my subscribers, Asim, had presented some data where Mr. Sharma had taken all 30 stocks that I had labeled as my magic formula stocks from the year before, and when mapped over the next year, this portfolio had delivered a 75% return. This made me happy and sad at the same time. Happy because the research had resulted in a 75% performance, which is undoubtedly brilliant. But I was also sad because although I had done the hard work, I had myself not invested in those stocks, which honestly made me look like a bit of a loser. ठीक है, होता है, and that's when I made a promise to myself कि चलो एक बार गलती हो गई, but इस गलती को दोबारा नहीं करूंगा. But little did I know that just like Asim, there was another gentleman, a Mr. Akshay Chauhan, who was keenly tracking a portfolio of stocks that had earlier presented called the Losers Portfolio. And he was not just tracking, he had also invested in it, and that portfolio had given him some handsome returns. Now, when I first heard about it from Akshay, I was a bit skeptical because सब कुछ तो बढ़ रहा है तो चलो ये भी बढ़ गया होगा. But फिर भी मैंने सोचा कि I should do some detailing around it, and so in this video we'll examine the losers portfolio in greater detail as we understand its history, its performance over time, the stocks that can be a part of this portfolio, and much more. Which brings me to IND Money, a popular personal finance application that tracks your finances, helps with goal planning, and also offers investment solutions ranging from mutual funds, ETFs, domestic stocks, US stocks, IPOs, fixed deposits, and a lot more. So very simply, the loser's portfolio involves intentionally investing in stocks that have performed poorly, that is, stocks that have experienced significant price declines. Now, the word significant is pretty subjective. I mean, someone might say a 20% price drop is significant, someone else might say 30%, even 50%. And because there is no one definition for this, I'll generally not want to go below 50% because that might mean something is structurally wrong with that company, and that's definitely something that we don't want. So just to illustrate, I'm assuming a cutoff of 50% as the maximum drop in stock price. When I pulled out a list of stocks whose market cap is currently more than 1000 crores, and after sorting them according to their last 1 year returns, two companies, that is Rajesh Exports and Raj Rayon Industries, seem to have exceeded our cutoff, and as a result, they'll be excluded from a loser's portfolio, while companies like Primo Chemicals, Best AgroLife, 197 Delta Corp, etc. will qualify within our framework. By now, I'm sure you would be wondering, ऐसा कोई सोचता है क्या losers portfolio? But incidentally, the inspiration for this video comes from an analysis cited by Professor Aswath Damodaran in his book Investment Fables, where it says that if an investor were to buy the 35 biggest losers over the previous year and had held these stocks for the next 5 years, then he or she would have generated a cumulative excess return of 30% over the broader market. Now, conceptually, why the losers portfolio might work is down to a couple of reasons. Firstly, there's the principle of mean reversion. That is, if the price of a stock is down, then generally it should rise up to its long-term average, and consequently, there is some money to be made there. And secondly, there are the contrarian principles. That is, by investing in a loser's portfolio, you're acting against the crowd, which, as many studies have shown, can be rather profitable. Professor Damodaran has talked about it in his book, but of course, since his analysis was done on US data, which is of absolutely no interest to you and me, and that's why I took it upon myself to do this entire exercise over a 10-year period on the Indian stock market so that the efficacy of the strategy can be understood, and if the numbers are solid, then probably everyday investors like you and me can implement it in the times to come. And it's not just about implementing, one has to track those numbers as well, which is where IND Money comes in with its rich suite of features, including a net worth monitoring tool that automatically keeps an eye on your assets and liabilities. You can track the current value of your stocks, mutual funds, FDs, gold, PPF, EPF, NPS, etc. And the results are presented in an easy to understand visual format. Next is goal-based investing that helps you plan your future needs like buying a home, a car, your kids' education, retirement, etc. And you can align different investments to specific goals with target timelines, and the IND Money app will handle all the tracking for you. The app also features an expense tracker, and once you've synced your savings bank account to it, you'll know exactly where your money goes across different categories without having to manually input any of the data. And lastly, the IND Money app automatically tracks all your credit card transactions, giving you detailed analytics. It also detects hidden charges, and you can check your credit score on the app at zero cost. In fact, every feature I've explained here comes to you absolutely free of cost. It's all automatic. You can set it up for all members of your family in a single view, which is very unique to this platform. And unless paper journals and complicated worksheets is your thing, it's time to step up your financial tracking by downloading the IND Money app today. As always, the link to the super useful platform is available in this video's description. Okay, so step one is to compile all the information. And as a part of our study, I extracted a list of companies whose market cap was over 1000 crores, which came to a good 1348 companies. Now, please note these companies that I've pulled out are in existence today, and all of them were very much there 10 years back also, that is in 2014. This is actually a problem because this means my data has a survivorship bias in it, which means I might have ignored some companies that were existing in 2014, 15 or 16, but are no longer there in our data set because in all probability these companies might have been acquired or merged or liquidated, spun off, delisted, privatized, etc. I'm sure there'll be some companies of this sort, but because every screening software has some drawbacks, we have no choice but to ignore this limitation. Anyways, once we have this list, step 2 was to pull out every stock. So all 1348 stocks, I had to pull out the financial year closing price, that is the stock price as on the 31st of March of every year from 2014 onwards. For this, I took help from Google Finance, and although I found some gaps in the data, I generally think the tool did a rather decent job. Alright, so for the first year of our study, I picked up the 35 worst performers of FY 2015, so the period between April 2014 and March 2015, and applying the 50% cap that I explained earlier, this list gave me companies like 63 Moons, Jindal Steel, Lloyds Enterprises, Sri Renuka Sugars, and so on. Now, because Professor Damodaran wants us to look at this as a portfolio of losers, let's say I invested 10,000 rupees in each of these 35 stocks. So that's an outlay of 3.5 lakh rupees. And an year later, that is on the 31st of March 2016, I find that this portfolio's value would have risen to 5.4 lakh rupees, giving me a 55% return, while the Nifty 500 during the same time period delivered a return of negative 6.5%. So 55 versus minus 6.5. This was definitely a promising start for the losers portfolio, and this got even better next year when the 35 loser stock portfolio I received as of March 2016 went on to deliver a return of 51% over the next 12 months, while the Nifty 500 grew in value by just half, that is at 25.5%. A similar pattern was seen in the next year with our losers portfolio delivering 23% as against the Nifty's 12.9%. But then came March of 2018 and the losers portfolio that we derived per our methodology failed to live up to our expectations, delivering a negative 9% return, while the Nifty 500 did 9.7%. I think the big drop in mid and small cap stocks might have something to do with this. But what this also shows us is that every strategy will have their ups and downs. And my presumption here is that the losers portfolio does not do well when there is a sharp correction in the markets. But let's see, let's just continue our examination for a few more years and see where it leads us to. Okay, so next up is the March 2019 portfolio, which had to go through the COVID impact. And as a consequence, it lost 54% in value between April of 2019 and March of 2020, while the Nifty 500 lost half of that at almost 27%. So I think what I said earlier about the losers portfolio doing well in a bull market and performing badly in a bear market seems to be holding true. And this was further evidenced in 2020 when the losers portfolio grew by 231% against 77%, and again in 2022 when it grew by 9% against the negative 1.2% that the Nifty 500 delivered. I'll say the only year where my hypothesis did not come to fruition was 2023, as many of the losers in our portfolio continued to be losers, yielding us a return of negative 11.8%, while the Nifty 500 returned positive gains of 40.5%. So this was quite a difference, but at least now we know how the losers portfolio, as per my methodology, compares to the Nifty 500 over the years, and at least mathematically, and on a 9-year basis, the losers portfolio, quite ironically, strategy has won the performance battle against the broader index. Alright, so we have the concept, we have a methodology, and because we have the numbers to prove that the system actually works, if you're keen on building your own losers portfolio just as an experiment, just like how Mr. Chauhan did it, then here are the list of 35 stocks you might want to consider, and this list is as of the 1st of May 2024. Of course, you don't need to exactly copy this. Feel free to apply additional things that you've learned on my channel. So variables like sales growth, EPS growth, PEG ratio, promoter shareholding, interest coverage ratio, return on capital employed, and stuff like that. Just don't go overboard with it by stuffing in too many criteria, but do remember this portfolio that we have just discovered, I think will only work if we treat it as a system, as a methodology, and strictly adhere to the rules that we have defined for ourselves. Actually, let me explain this part in detail with a couple of observations here. So let's go back to the first data point, that is the FY 2015 list. And when I look at the performance of those 35 stocks as of the 31st of March 2016, we find that just one stock, Dwarikesh Sugar, was singularly responsible for the big performance jump in our portfolio as it grew by over 10 times in that single year. Now, the problem is if you don't treat this portfolio as a system, then the moment this stock, this Dwarikesh Sugar, goes up by say 2 times or even 3 times, you'll be very tempted to sell this stock saying that iske upar to ye stock ja hi nahi sakta hai. But the fact is, this is not an isolated incident, with constituents of the losers portfolio across years showing a lot of variability, with many of them doubling in value while a few of them also losing half of their value. In fact, in the earlier video I made on the contrarian strategies, the 35 stock loser portfolio I featured there had actually given us a 5-year CAGR of 91%. Yes, you heard that right, 91%. But if I were to remove just 4 stocks, Orchid Pharma, Best AgroLife, Patanjali Foods, and Raj Rayon Industries, then the annual return of this portfolio comes crashing down to just 31%. Which brings me to observation number 2, which is how long should we hold these loser stocks? I mean, is this something we should keep for just 1 or 2 years? Or can I hold this portfolio for a longer duration of say 5, 6 or 7 years? It's an important question, so I went back to the data, my trusted 9 years of data, and I mapped out the trailing returns across years that you can see in this table here. Okay, now this can be looked at in different ways, but by my reckoning, years 1, 2 and 3 seem to be the most profitable for a loser stocks, and over time that bump up seems to dissipate away. Now the ones I've marked in red are the outliers. These are the COVID years, and if I ignore March of 2020 and let's say March of 2021 as well, which was more of a recovery year, even then the early years seem to be the more profitable ones. So if you're keen on trying out the losers portfolio as an experiment, then keep a holding of 1, 2 or a maximum of 3 years and see what happens. But just in case you decide to hold on to these stocks for a longer period of time, actually let me just give you the numbers, and honestly I was not sure if I should be sharing this with you as it can lead to some confusion, but still let's have it. So if I had held on to the loser stocks, or rather if I had put in 10,000 rupees in the top 35 loser stocks every year, that is in the year 2015, 16, 17, all the way until 2023, then I would have invested some 31,50,000 rupees on a staggered basis, and the value of these stocks of this portfolio as of 31st of March 2024 would have come to a staggering 2 crore 23 lakh rupees, which gives us a CAGR of 38.5%. I repeat, 38.5%, and in comparison the Nifty 50 would have delivered just 14.7%, and even one of the best performing actively managed mutual funds during this period, the Parag Parikh FlexiCap Fund, would have delivered just 21.5%, and here we have this group of losers, this losers portfolio strategy that has delivered a return of 38%, which is absolutely amazing. But having said this, don't forget survivorship bias, because I'm pretty sure there are some non-existent loser companies that our screening software is unable to provide, and this would definitely reduce our returns. By how much? Well, I have no idea, and I can't even guess that number on what it might be, but as I've always said, investing is a game of probabilities, and it is very probable that the loser's portfolio would have done adequately well and is therefore worthy of a consideration to be run at least as a small and simple experiment. If any of you are keen of jumping into this, then I'll really appreciate if you can drop me an email from time to time and let me know how this is working for you. Once again, thank you for your time. A big thank you to Akshay Chauhan for inspiring me to take up this topic. Please share this video with others, subscribe to my newsletter, and I'll see you very soon. Until then.